Welcome to Home Buying Made Easy podcast. We are going over all things as it relates to home buying and the home buying journey, trying to keep it simple. My name is Michael. I have Rachel with me here as well. And I have a green Hawaiian shirt on. I wear a Hawaiian shirt every day. You know why I wear a Hawaiian shirt every day?
Because you love Hawaii.
I do love Hawaii, but it's more relaxing. You know, it's laid back. It's like when I was in Hawaii, people get lays and, you know, different things at the luau's. I was there and I asked, wow, this is not going to work. Well, kind of going to work. Okay. These are, it's some kind of a nut.
They look like rocks.
I know, but it's like it's a Hawaiian thing.
Okay.
So yeah.
Are you going to wear that the whole time?
You want me to wear them the whole time?
I just wasn't expecting you to wear them. So
there you go.
Here we are.
Here I am in the little watch. This is actually, it's got little H's on it, like
for the University of Hawaii.
Yeah, it's kind of cool.
It's tugging on your headphones.
Oh, thing, do I need to take them off?
You don't have to. Just like watch the. Let's pull it out a little bit. There you go.
All right. Well,
okay.
So what are we talking about today?
Today we're gonna do 5 questions. So I have a list of 30 questions. Today we're just gonna answer 5 of them to make the episode not super long. So yeah,
5 questions.
5 questions, and they're different things. So it's not all the same. It's not all the same topic. So
I would hope it'd be different questions.
Okay.
5 questions. So what's question 1?
Okay. So question number 1 is, do I need a perfect credit score to buy a home?
Yes.
How does the credit? Okay. Wow.
That's a quick answer. No, no, you don't need a perfect credit score. There are different loan opportunities, loan types that would allow you to have maybe a lower credit score. Example, conventional loans as a whole have always required a pretty high credit score or reasonable credit score, fair to good, in order to get a loan. Now, Fannie and Freddie just recently dropped that off of the credit risk profile. So there's this software they run, and when they run, both Fannie has one and Freddie has one. And you run that software to determine if you're qualified for a mortgage. Okay. They just dropped off the whole FICO score, the credit score part of that, because they look at the whole credit profile. They look at how many lates you've had. So you pull the credit. The score is just one small aspect of it, but the actual credit profile is what happens. Like, how much credit do they currently have outstanding? Do they have high balances on their credit cards? Do they have late payments? Do they have a lot of late payments? Do they have a bankruptcy? Do they have a foreclosure? All those play into it. And there's guidelines. We talked about guidelines in a previous episode, but there's rules in place. Like Fannie has a rule and Freddie has a rule. If you have had a foreclosure within a certain amount of time, you can't get a mortgage with them right now. Same thing's true with bankruptcy. If you've had a bankruptcy, you have to wait a period of time before they'll allow you to get another mortgage. And FHA has that, but they have different rules. So each type of loan has its own set of rules for what they allow as far as credit risk. So FHA, for example, will go down to a 580 credit score. And then they'll even go lower, but you have to do what's called a manual underwrite. It's a completely different type of loan. And the loan process takes a good bit longer, and you got to jump through all kinds of hula hoops to be able to do it. But it is possible with lower scores to do it. The cool thing about a VA loan is that there's no credit score minimum. And as long as you haven't had any late payments within the last 12 months, you can almost every time you're going to get approved. If you've had maybe one, there are certain lenders that will allow maybe one late payment within 12 months. but you have to do that as a manual also underwrite. So there's an automated process, which is the software process that makes it a little bit easier. And then there's a manual process where they go through the loan and like with a fine tooth comb, so to speak,
Right.
and they say it meets this guideline and it does this, and they have this thing. It's called a compensating factor. Big word. Compensating factor is where you have additional things that you could do to make your credit profile look better. If you have money in the bank, that helps. Or if you have a VA disability rating, that helps. So there's some things like that.
Okay. And staying on the topic of credit and credit score, is there ways to improve my credit, and how do I do that? What's your advice on?
Yeah, there's a lot of things that go into credit repair. There's companies that do it I mean, that's what they do.
Yeah.
They work with your credit repair to or work with you to get your credit repaired. And I would say reach out to a credit repair company. There are some valid ones. We can give you some recommendations. Like I don't necessarily endorse one of them because I've used several different ones. They have different price points that they charge for that kind of thing. And the big thing is don't just do it and throw your money away every month thinking they're doing something. Find out the details of exactly what they're doing to help you in the process. They can write letters for you to the your creditors, and there's things they can do to do that. But the first thing would be you can go to freecreditreport.com and get a free credit report every year. You can get one free every year from each of the bureaus. I would do that to find out what your credit is and what's on it. And then the first step is don't be late. Like just make your payments on time and at least make minimum payments. And then if you've maxed out credit cards, you need to work towards getting those paid down because when you pay your credit cards down below 30% and then down below 10%, it bumps up your score a lot. It creates a better credit profile. So that's super important. Those are the biggest things I would say.
Okay. Sounds good. Let's do number 3. Question number 3 is going to be, how much money do I really need to buy a house? We kind of covered it a couple episodes ago with what all goes into it, but who's getting paid and what's that look like? What's the breakdown?
Well, there's a down payment that's required and there's closing costs that are required. Things like in most cases, the way the industry has been set up, the real estate industry has been set up to help the buyers by having the seller pay for some of the fees. Some of the fees might be some of the title fees. They could pay for some of the real estate agent's commission. A lot of times the seller will do that. And the seller's offering to do that. It's not that the seller's required to do that. There's actually a big, huge lawsuit with the National Association of Realtors over who's required to pay what and everything. And they're not required to pay it. That's just the way that they've done it in the past to keep the costs of the buyer down. There's also in certain markets, the seller may be able to pay closing costs like as a concession or a seller contribution, which will keep the cost down too. So the numbers that you're looking at though, let's say you're buying a $400,000 house. If you're going to buy a $400,000 house and you're going to put the minimum conventional amount down, that would be in most cases 5%. There are a few first-time home buyer programs at 3%, but overall, most conventional buyers are at least 5%. So 5% is going to be $10,000. 400, 40, no, $20,000.
20,000. There you go.
My bad. $20,000. Bad math. Okay, so $20,000 is the down payment requirement. And then on top of that, you would have closing costs. And closing costs would include an appraisal. It would include paying for your credit report and the title fees, the property taxes that are going to be escrowed. It's called. We'll talk about escrow sometime. That's a big word, right? I know what you're about to do to me. You're going to make me answer that question in just a minute. I see it coming. We'll talk about that. There's several things that go into the closing costs that are all part of the real estate transaction. I would say if you had to pick a percentage, you're probably looking at 2 to 3% of whatever that purchase price is. So again, 3%, $400,000 purchase, 3% would be 4, 8, $12,000. Okay. So saving up 12, maybe 15,000 for your closing costs plus your down payment, you'll be looking at $35,000 on a $400,000 purchase.
Right.
That could be higher or lower depending on seller providing some concessions or something like that. But that would probably be an average.
Okay. The next question I'm going to ask is, what's the difference between pre-qualified and pre-approved? Because we talked about pre-approved last episode or 2 episodes ago, and you explained that, but what if someone says, oh, I was pre-qualified for this amount? What's
pre-qualified?
Like?
So there are certain lenders, there are certain very large lenders that will let you go onto their website and put in your information, basic information. So, Rachel, how much money do you make per year? Just make up a number.
$42,000.
You make $42,000 a year. Okay. So you make $42,000. Do you have good credit?
Yes.
Good. You have good credit. Do you have about $35,000?
Right in my back pocket.
There you go. Okay. Well, I really hadn't checked your credit or done anything yet. I could check your credit, but it looks like you're pre-qualified. There you go.
Wow.
There's websites you can go to and get pre-qualified by just filling out a little bit of information and putting in a number. And I could put in $500,000 that I make $500,000 and I have $200,000 in cash available for a down payment, and then I could get pre-qualified for $1 million or whatever. But it's just a pre-qualification. Nobody's really checked a whole lot. In some cases, pre-qualified does mean they did pull credit and they looked at your credit and they've built it based on your credit. And we'll talk about debt to income ratio at some point. But overall, it's pretty loose as far as getting pre-qualified. Pre-approved means this: a loan officer's pulled credit. They've looked at your pay stubs. They've looked at your bank statements to see that you have the money to be able to get this, to put the down payment down and pay the closing costs. They've run it through those automated systems, those like Fannie and Freddie have their software that you use. They've run it through those systems to make sure that this is a good loan. And then once they've done that, in some cases, and our team does this, in some cases, when you have like a self-employed borrower, we will actually send it to a pre-underwriter and let them underwrite that and say, hey, yeah, we're good on the income and everything looks fine. So that's more of a pre-approval process. When you've had automated underwriting done, everything's been looked at. Like you've looked at the credit to make sure there's not any late payments. You've looked at the statements to make sure that the funds are there. You've looked at the pay stubs. You looked at the W-2s. Everything looks like it's a good loan. And at that point, you can be pre-approved. That's the difference.
So it's a confirmation.
Confirmation using documentation.
Right. Okay. And the last question I have for this episode is, you are a wholesale mortgage loan officer. What's the difference between wholesale and retail? Because those two are thrown around a lot. Can you provide some insight on that?
Yeah. So I am a wholesale mortgage broker. Okay. And there's a misunderstanding in the world of mortgages about, okay, brokers, you have to pay more fees and you pay all this stuff. The actual truth of that is mortgage brokers are actually usually have lower fees sometimes by $8,000 to $10,000 over retail lenders. Now, here's the difference between the two. A wholesale mortgage broker, in my case, we have over 150 lenders that we can choose from. So we shop around. We can take your financial situation, your scenario for your mortgage, and then go to different lenders. So we pull credit one time. And then after we pull credit, we can like go to the different lenders and say, hey, here's the loan. Here's what it looks like. What would your interest rate be? And what would the fees be? What would your fees be? What would your interest rate be? What would your interest rate be? So we do that. We could do it with all these different lenders, and there's a lot of great lenders out there that do loans. At that point, we get you the work to get you the best rate and the lowest amount of fees all at the same time. That's what a wholesale mortgage broker does.
Mm-hmm.
That's on the wholesale side. That means we're going direct to these investors, and we're a third party coming to those investors saying, hey, I got a loan. Do you want it?
Mm-hmm.
If you do, give me your best rate. Give me your lowest fees. Now, in retail world, you're with one bank or one banker or one mortgage company bank, and you're working with that particular person or that particular mortgage banker. Okay. There's a lot of different terms for it. If you're working with that one investor, they have one interest rate. So you pull credit with them and you go get that interest rate. That's what they're going to offer you, and their fees are their fees.
Mm-hmm.
And if you want to go shop, then you have to go to a second mortgage investor, banker, and they pull your credit and you fill out another mortgage application, and they will give you their rate and their fees. If you want to do it again, you go to your local bank and do the same thing all over again.
Right.
You're pulling credit, pulling credit, pulling credit. Whereas in the wholesale mortgage broker world, we can just pull credit once, shop around for you. That's one of the big things. The other thing is very simple to explain, kind of like you do when you go shopping. You can shop at Macy's and all these different places at the mall. Those are retail. Or you go to Costco. Costco's wholesale. Now, in Costco's world, you're wholesale and you got to buy like 4 million bottles of olive oil in order to save money. It's a little bit different. You don't have to buy 4 million different mortgages in the mortgage world. So it's just a difference. You get better rates usually. And I don't want to automatically make this blanket statement that all rates are lower by a broker. There's some brokers that charge more, I'm sure.
Mm-hmm.
But if you're able to shop and be competitive, then it makes it a whole lot easier to go to multiple people or multiple lenders, investors, and say, hey, give me your best shot. And then that's where we can take it. What we do is we do a fancy little sheet. It's called a green sheet. It's real fancy. Green sheet. You know what color? You know what color it is?
Red.
No, it's green. It's a green sheet. And we lay out different interest rates and let them pick their rate. So the way rates work, we'll explain in an episode at some point, but the way rates work, there's a rate sheet and you can fall anywhere on the rate sheet that you want to. If you go lower in rate, you pay for that. If you go higher in rate, the lender gives you credits for it. So we'll talk about that on a different episode though.
Yeah.
So does that explain, like there's wholesale and retail?
Mm-hmm.
In many cases, retail ends up having higher rates because they have a lot more overhead.
Right.
So I worked for a retail operation many years ago, and they have over 2,000 between processors, underwriters, and different people in their company. And all those people got to get paid. And so there's all this overhead. There's buildings, gigantic, huge operations centers. All of those places cost a lot of money to run. So there's a huge overhead in a lot of those businesses. With our mortgage brokerage that I'm a part of at Edge Home Finance has low overhead So we're just giving that back to the
Right.
clients. Keeps the overhead low, and you don't have to have all those extra fees.
Yeah. Okay, that concludes the 5 questions for this episode. The next episode will cover escrow, which you mentioned, and how the rates work.
Oh, we're going to hit rates and stuff.
Yep. So
Okay.
check out the next episode for answers to those questions.
Interesting. Okay. Well, we'll see you next video. Thanks.